Hi here. So a quick update on the markets. As you know, last year in October we started a bear market that brought the market all the way down to about 2003, and it was a very short bear market. It was a non-recessionary bear market, so it lasted just about 3 months. As you've been following my videos, you know that once I saw that change in trend, I started shorting the market at about that level by using put options. So I short the market so I can generate some short-term profits as the market goes down. All right, because I've got my long-term investment portfolio that will go down temporarily. So I short the market to generate profits to add on to my long-term portfolio that may see short-term volatility. So I short in order to hedge my long-term portfolio. So as it went down, it started to reverse over here, right? That was a clear bottom. So that's when I started to close my short position. So I made some quick profits shorting the market over there that added to my long-term portfolio. So some people would ask, how would you know that the market started reversing over here? That how did you know that it was the bottom? Okay, so here are a few clues. Now, one of the things I notice is that a market tends to hit the bottom when it starts to go 90 degrees down. Okay, in a normal downtrend, the market will tend to move in a 45-degree angle. And what happens is just before the market bottoms, it will drop at a 90-degree angle. And we call it a parabolic drop. And normally it is followed by a series of at least 6 to 7 red candles in a row, 6 to 7 bearish days in a row. Okay, and the moment you see that 90-degree drop, it's kind of like going for amusement park rides. So you get Universal Studios or Disneyland, you go on a ride, and normally before the ride ends, there's that final plunge that scares the shit out of people, right? So whenever you see a 90-degree plunge, get ready for the bottom. Okay, now once you see a bullish candlestick pattern, for example, a bullish engulfing pattern or a bullish pin bar or a one white soldier. Now, if you don't know what these candlestick patterns are, you can watch my video on candlestick patterns, right? So again, candlestick patterns can't be used by itself in isolation. It must always be used with a certain price structure. Okay, so again, when you see a 45-degree, 90-degree plunge, and you see a bullish engulfing pattern, so in this case, this was a bullish engulfing pattern. Well, not really, sorry. This was what we call a one white soldier pattern, not a bullish engulfing, a one white soldier pattern, or a bullish engulfing or a bullish pin bar. That's a clear sign that the market is bottom and we are going up right now. So as an investor, as a trader, you got to be very flexible. Okay, so once you see that the market starts to change, you have to reverse your position. So from going short, once I saw that, I started to go long again. I started to close my short positions to take profits on my short positions. At the same time, I started to add more long positions, started buying more stock. Especially when I saw that the market started going up, crossing above the 50 moving average over here. Let me just scroll it on the right. There we go. So especially the moment it crossed above that 50 moving average and the 20 EMA crosses above the 40 EMA, that was a clear sign that we are in an uptrend again. So I started adding more to my long positions over there. And I said, hey, the market's going up right now, but I said we got to be careful with this level. This is a strong resistance level that's been tested multiple times. This is the 2800 level. Okay, so I said that, hey, we are going back to test that level. And I said, if it hits 2800 and it can't break that level, there's a chance that it could go all the way back down again to make a double bottom. All right. So what happened? Let's see what happened. So the market went up, it hit that level, it came down, hit that level, came down, and I said, hey, it could sometimes be a false breakout. So I would wait for a close below the 20 EMA and the 200 moving average to start going short again, right? To start shorting the S&P to hedge my long positions. So what I did was, the moment it hit the 2800 level, I initiated my first round of short hedging using what is known as an iron butterfly with options. So the great thing about the iron butterfly is that I'm only risking $1 to make about $20, right? So it's kind of like insuring my portfolio. So if my portfolio goes down, it pays me 20 bucks. If it doesn't go down, it goes up, I lose $1. So I started initiating that position over there. I'll show it to you on my portfolio in a while, right? And what happened was it kept going down slightly. Let me just zoom in over here. All right, you can see it went down. And on this day, you can see it closed below the 200 and the 20 EMA. So at that time, I thought, okay, it's going to go all the way down. I started to short more of the S&P 500. I bought put options, or rather put spread options there. Now, in hindsight, in retrospect, I shouldn't have done that, right? Because I normally like to see a strong close below the moving averages, okay? But what happened was, although it closed below the moving average, over here, what happened was that it actually formed a lower shadow that shows rejection of the lows. In other words, the bears are pushing it down, the bulls are pushing it back up again. So in retrospect, I should not have shorted. I should have waited for another day, but anyway, I shorted, right? So I started shorting the markets over here, I shorted over here, I shorted over here, and guess what? The moment I shorted it, the next day it reversed back up again. So that happens, right? So I keep saying that no one can predict the future, all right? It happens, okay? So the moment that it reversed back, now from going short again, or being bearish, now I'm bullish again, right? So as an investor and trader, you're gonna be able to be very flexible and shift your positions. So because of that, guess what? My short positions that I made here and here are now making losses. Obviously, they're making losses, and that's fine, right? Why? Because the reason I'm shorting the market is to hedge my long positions. So it's kind of like buying insurance. You're paying a premium to protect your portfolio. So if it collapses, the insurance will pay out. You make the money to offset your investment portfolio. So when it went up, I started losing money on those short positions. It's kind of like you buy insurance on your house every year. You buy fire insurance, correct? You pay a premium. And what happens is if the house burns down, you get a great payout. That's what I was looking for. But in this case, the house didn't burn down. In fact, the house increased in value, right? So when that happens, you get angry and say, damn it, I shouldn't have bought that insurance premium because my house didn't burn down, right? You don't care, right? Because treat it as a cost of protecting your portfolio, right? So basically, when that happened, my put options, my short position cost me about 1.5% of my portfolio, all right, which is basically the cost of protection. I'll show it to you on my portfolio in a while. And so I decided to close half my short positions, not fully yet, so I've still got half of my short positions left. Why? Because although I'm short-term bullish again, because of this bounce off here, and we've got this very strong action, again, it hasn't really broken that level. In fact, yesterday, you can see it closed with an upper shadow, so we could still be going down, right? So, but I said, okay, right now it's back above the 200. I closed half my short positions, and I'm leaving them half on, okay? So, let me just show it to you over here. You can see that there we go. So this is my short position. All right, this was my initial short position, which I did using what is known as iron butterfly, but they call it an iron condor in this app, which I don't know why, right? So you can see that I'm right now at my maximum loss of $138, right? Why? Because it went up instead of going down. Now, if it had gone down, I would have made about close to $2,500 on this one, about $2,000, right? So like I said, it was a 1 to 20 insurance policy. So it's a loss, and it's fine because it's buying insurance, right? And so that's the one which I initiated over here. When it went down here, I started to add in more put options. So yeah, that's the one over there. So you can see that these were the put options that I bought, and it's down about $1,500. All right, but it's okay because I hedge it with another set of puts over here that gains about $400. So net I'm down about $1,100 currently, right? But I did close some of my short positions that were down about $1,000. So overall, basically the loss on my short positions only represent less than 1.5% of my portfolio. And this particular portfolio that I was hedging, you can see that year to date, it's still up about close to almost 20% for the first 2.5 months of the year, right? Which is on track. Normally, for all my portfolios, I target to make at least a 60% return a year, 50 to 60% return a year. Anything less, I'm not too happy, right? So if I'm getting 20% by the first 2.5 months, pretty confident I can hit about 50-60% return for the rest of the year, right? So you can see that when you hedge your portfolio, okay, in other words, you're betting that it's going to go down, you're hedging your portfolio, and if it does go down, yeah, you make a lot of money that would offset the temporary drop in your portfolio. But in this case, when it doesn't turn out and it goes up instead of going down, then you have to lose that money which you paid to protect your portfolio. So the point is this, right? Hedging is great because it allows you to profit when the market collapses, to protect yourself. But hedging comes with a cost. It is not for free. So in other words, if the market goes up, doesn't go down, you will lose money on your short hedging. And it's fine, treat it as buying fire insurance. It's part of the business of growing your portfolio. But like I said, I've only closed half my short positions because we're not out of the woods yet, right? We are still facing this resistance over here, so we could still very well go all the way back down. And if it does, I will add my short positions again, or buy more insurance again. But for now, I've closed half my short positions, and if it breaks above strongly, then I'm going to add a lot more long positions, because if it breaks strongly, then I expect that the next level it's going to hit would be the previous high of about 2,900. So a lot of money to make on the way up here. All right, so that's quick market update. It's Adam Khoo. Keep watching. May the markets be with you. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.